Welcome to the Rose Show podcast. Today, I recorded a macro discussion on Twitter Spaces. I unfortunately was not able to record that space or any of my discussions, so I will recap that for you here. There were some interesting points that were made, and I think it's very important to enlighten everyone with the points that were raised for our economic conditions in the US and globally in 2022 going into 2023. Of course, there's a great deal of uncertainty and a lot of moving parts. So things can change rapidly day by day. So as of right now, which is the beginning of December of 2022, this is the outlook that we foresee, but it can change at any time, and it is only our perspective as well. So here we begin. Global economic collapse. Which industries are most affected? Let us begin. The macroeconomic policy landscape has shifted rapidly during the past year, with policymakers facing an unusually uncertain environment. We are inevitably part of a global community with many moving parts filled with growing tensions and uncertainty coupled with worsening global outlook. Some permanent output losses are expected in many economies. So, in order to address this question, we must first ask, will there be a global economic collapse? We don't know. I am a skeptic in business, investing, and in life, and am hopeful a collapse will be averted. No doubt the current environment is particularly challenging amid slowing global growth and elevated inflation. So, for the purposes of this discussion, we will assume a significant global slowdown and recession. Collapse may be too extreme of a word at this time. Let's examine the industries most affected currently from the many existing global challenges which are persistent and seem to be rising. Not only are there high uncertainties and growing fragilities, but the risks of monetary, fiscal, or financial policy miscalibration have risen significantly. Global financial conditions could deteriorate further. Inflation appears to be embedded at many levels, as elevated inflation is a global phenomenon and challenge. Bringing down inflation is a key policy priority. As a result, global financial conditions have tightened. The global recovery has weakened since the pandemic, and inflation pressures have intensified with the most vulnerable groups facing the largest impacts. While most countries continue to grow, the pace of growth has slowed, and some economies have fallen back into recession. World output is declining in 2022 and even more so in 2023. These unprecedented supply shocks, their persistence and size, mean that policies will have to tighten to facilitate adjustment to a new equilibrium. Simple answer, everything will be affected. Now, the gravity of how each industry is affected will vary by many variables. Some industries will exhibit less contraction than others. Therefore, the effects are non-binary, rather on a sliding scale of degrees. Has inflation peaked? Possibly. However, I believe elevated inflation, which is the concern, could remain for some time with a global recession possible in the near term. We have seen inverted yield curves for some time here in the US, the 10-year 2-year yield curve, as well as the 10-year 3-month. And now the global yield curve is inverting as well. The 10-year is below the 1 to 3 year. Increasing pressures on prices remain the most immediate challenge to prosperity by pinching real incomes and undermining price stability. Under-tighten and further entrenched inflation. Over-tighten and push the global economy into a severe recession. It is a delicate balance, with stagflation as a potential outcome. I repeat, bringing down inflation is a key policy priority. We also need to address elevated debt levels. In order to facilitate adjustment to the new state of the world, tighter policy stances may be needed to address the persistent multiple global supply side shocks. Despite recent declines in commodity prices, energy concerns have grown due to the multitude of geopolitical issues centered around Russia-Ukraine conflict. High food price inflation is prompting a cost of living crisis. We can expect monetary policy to continue to tighten globally, with the degree to vary by country, dependent on where inflation remains high and labor markets tight. Thus, higher interest rates are most likely needed. Fiscal policy will need to tighten in many economies to address debt susceptibilities. Therefore, housing, which is interest rate sensitive, will most likely be challenged. Industries exposed to greater debt and capital expenditure reliance will face greater challenges, and we should proceed with caution. Manufacturing is contracting. New orders are softening and contracting. Production is decreasing. Prices are decreasing as well, too. Exports and imports are contracting. Companies appear to be preparing for future lower output as output and consumption is declining month over month. Demand has eased. Real demand is softening, but prices are still elevated. Cost reduction is still a primary focus for all. Margins are compressed with rises in the cost of capital, debt, production, labor. As a result, cost of goods sold and operating expenses are much higher. Seemingly, revenues are being held up more so by inflation and increased prices rather than higher output or volumes. There is a dilution of value. Corporate earnings are also already under pressure due to compressed margins, and I believe should continue and most likely worsen into 2023 amidst global growth slowdown and tightened policies. Therefore, deteriorating earnings as well as upcoming employment issues could be our next hurdles. All industries will be affected. The defensive, more inelastic industries, which are necessities, such as utilities, healthcare, medical equipment, some biotech, consumer staples, industrials, and some select tech, which can also be deemed essential, and or renewables with solid fundamentals could fare better. However, I am cautious with equities and bonds and the 60-40 portfolio, which may be less ideal as equities could experience further downward risks. And I am looking more towards commodities and remaining liquid with cash. Remaining liquid and reducing debt are key amidst tightening liquidity within restrictive monetary and fiscal policies. When looking at investments, cash is king. Free cash flow yields, free cash flow margins, rising earnings, etc. We can look at historical patterns during economic crises, various business cycles amidst slowdowns with elevated inflation and potential unemployment challenges, which could signal stagflation. However, times differ, so we remain open-minded and flexible in a world in flux, filled with uncertainty and a rapidly changing landscape. Regardless, continued monetary and fiscal tightening is most likely needed to tackle inflation and address debt susceptibilities, and these actions will continue to add pressures to economic activities, especially to sectors with more interest sensitivities, such as housing and other heavily debt-dependent sectors. This will take time to work through, but there is light at the end of the tunnel, as always. After the darkest times, the light always emerges again. Thank you. So, monetary versus fiscal. If you aren't aware, I'll share with you. Monetary policies involve interest rates, employment, growth, stabilizing prices, and that is by the Fed. Fiscal is more of a governmental policies. They are taxation and spending. So government spending when you look at the budget and so forth. So that's the difference between the two. Now, stagflation is when you have elevated inflation, highly elevated inflation, which we do have a persistent elevated level of inflation at this time. And there's also slowed growth, which we are experiencing at this time. And per the GDP world output, we're on a global scale will be lower next year in 2023 than we are now. So we are slowing down. The third caveat, the third part to that is high unemployment. So currently we have a very tight labor market. However, we will discuss a little later on how there are some inconsistencies in the data which could signal to us that we don't need to soften as much as we believe. So right now, it appears our unemployment was at 3.7%. So we're at the low end. So stagflation usually involves having high unemployment. So I would say we're not really there yet. However, some believe we are in that state or we're entering it. My opinion is that it's very possible in the near term future. Well, looking at globally, we have a lot of issues recently with UK and their bond situation. Obviously, the conflict, the geopolitical issues, Russia, Ukraine, China, which is the next part, the next question we're going to answer. There was a real estate bubble in China. There are a lot of issues going on. I found out today, they use copper for collateral for loans in China. I was unaware of that. So very interesting information. And as I learn it, I love sharing it with all of you. So these are all interesting tidbits of information to make sense of. And it all makes sense in the greater picture of our global outlook. I think housing challenges are incoming, especially with the rising rates, which tends to soften housing and the real estate market. So, and then, I'm very cautious with bonds as well, especially if we have issues with China continuing and being exacerbated. So we just need to be aware of all that, which is why I said the 60-40 portfolio may not be the best positioning right now. That's my opinion. Just proceed with caution because there could be more downside risks. Now, how's China's economic restrictions? How are they impacting the world economy? Now, that is a great question. So let's see what we can figure out here. Well, we are in a global community with all nations interrelated. So when a major contributor to the global economy has economic restrictions, it impacts the world economy significantly. Global growth has slowed, and the US and China, the two top GDP contributors to the world output, have large impacts. Thus, China's economic restrictions will most likely contribute even further to global slowdown. During this time of global challenges and tightening, we actually need growth-enhancing structural reforms to help economic activity, including strengthening trade policies such as reduction in tariff and non-tariff barriers to aid in facilitating international trade and alleviating global pressures. These policies could also help to reduce inflation by reducing import costs. Therefore, China's economic restrictions come at the most inopportune time and only compound our global challenges. In order to effectively collaborate together in a global community, I would also like to mention transparency is an issue. We can only work with the data that is provided to us, so we should account for varying margins of error with potential inconsistencies should they emerge. I would like to provide a backdrop for this discussion for the listeners and attempt to simplify these global issues and China's involvement. First, we need to discuss what contributions China provides to the global economy and its role among the players to assess these impacts. China now has the second highest GDP with significant growth in the past decade. It is the number one exporter of goods since 2009. Based on low-cost manufacturing, investment, and exports, which seemingly reached its limits and has led to imbalances economically, socially, and environmentally. It is plausible that a shift in the foundational structure of its economy from manufacturing to more high value services, investment to more consumption, and from high carbon to low carbon intensity could facilitate reducing these imbalances. There is no doubt that China's growing economy is an important source of global demand, and economic restrictions will only further negatively affect the global economy already under serious pressures. Moreover, both exports, less production, and imports, less consumption, will be under pressure, thus affecting other countries with their exports to China as well as their imports from China. China is responsible for a significant proportion of global trade in telecom, tech, semiconductor parts and equipment, as well as natural resources. These equipment and commodities serve as essential materials for many goods and services worldwide, so limitations should cause more short to midterm supply chain strain on these necessary materials, further adding pressures to worldwide supply chain challenges, and, depending on the demand at that time, prices could rise further accordingly, thus adding to the existing global inflationary pressures. Furthermore, if there are reduced exports due to the restrictions, this could potentially provide opportunities for other emerging manufacturing exporters and may eventually reduce some of our reliance on China. It can also serve to aid China in eventually balancing their economy to more high quality growth and reducing their per capita emissions while hopefully not exacerbating financial risks. The key here for the world economy is they may be forced to reduce reliance on China while reallocating the manufacturing of these goods that were China manufacturing dominant to other countries. A quick example is semiconductors, as we see with the US, and it's enacting the CHIPS Act. Therefore, this could encourage other economies to grow and increase global participation. So while there may be short to midterm volatility, eventually, we are hopeful there could be long-term benefits. Maintaining and improving global trade and investments is our goal. No doubt there will be volatility on the global economy and additional constraints of supply chains and global trade while we are already amidst high inflation, geopolitical issues, energy crisis, food shortages, and more. Therefore, the greatest risk facing the global economy near term may be further elevated inflation, causing central banks to continue raising rates, thus maintaining a higher cost of debt and capital for consumers and businesses, which will further slow growth. This elevated inflation, which undermines growth, needs to be curbed in order to avoid further entrenchment, which can anchor high inflation affecting labor and price settings, which affects financial and household decisions. These international tensions going on with Russia and China and the rest of the world not only add to inflationary pressures, but also to our energy and food shortages. Food scarcity is a very real concern. Of course, I am hopeful and prefer that as a result of these challenges, we shift to more renewable sources of energy and invest in more resilient and productive agriculture while providing support for the farmers. Short to midterm pain to hopefully offset greater pain ahead. In conclusion, challenges bring forth new opportunities and solutions. We always find a way to improve and be better. Adaptability and innovation. I believe in humanity. These short to midterm global challenges from China's economic restrictions should bring forth opportunities in the global economies for others to emerge and grow that may help alleviate and elevate their cost of living status with improved food supply chains and lower carbon footprints for the future, as well as maintain and improve global trade with a new equilibrium. So, what we're seeing is some people are saying there's a bull market in China, the commodity bull market, China's reopening. Then we hear from inside sources, friends in Shanghai and Beijing, and I have quite a few Chinese American friends whose families are in China, and we hear a different story, how businesses are closing, everyone's on lockdown, and people are just have no civil liberties, and they're just very upset. It's very heartbreaking, and it's so sad. So we feel for everyone in China. So it's hard for me to believe that there is a reopening going on. I proceed with caution. Any Chinese stocks such as Baba, Baidu, PDD, and there are quite a few other ones, KWeb, that's the ETF. I proceed with caution with all of these. This is not financial advice. I'm no buy recommendation or sell, but I have traded them, and they were very volatile, and they were good trades in the past. I'm not looking to initiate anything in China, but there's a reason why they're so undervalued. And you always say, what a good value. They have great earnings growth, and they have a low PE. Well, you have to factor in the geopolitical risks, and there are quite a great deal of those between, delisting to what's going on right now, and there's always something going on. Unfortunately, it's really unfortunate for the people of China, but we have to proceed with caution when it comes to investing in those stocks and those equities. So for me, they're trades. I wanted to mention that, with this discussion with China, if it does get worse, I'm very cautious with bonds. Bonds are something that would definitely get hurt. And also luxury brands. And this was a great point that was raised today with Daniel. He's a fantastic economist. He was on the panel today, PhD in economics from London. Lacal, I think. I apologize. I should really look up his name and give him full credit. But he did mention to proceed with caution with bonds and luxury brands, because a lot of luxury brands use production in China. So they could very well be affected. I see he goes by Daniel. So Daniel, Dr. Daniel, we'll call you. And then entertainment will be affected as well. There's a lot of entertainment that comes from China. And let's see, and another negative is the airlines and autos. I'm not a fan of those. They're very cyclical. The automobile industry is cyclical. So those are right now not very favorable. That was in our discussion today. And and hotels are better than those. That was discussed as well. So I'd like to move on to the next discussion, which is, should we expect the Fed to cut rates in 2023? I prefer to ask, should the Fed pause? Because I do believe there could be a pause next year unless something breaks in the market, in labor market, or the housing. I don't foresee any cuts, maybe December next year. So let's begin. We can all agree that inflation remains obstinately high and has become more widespread. Consumer prices began rising significantly late last year in 2021 and have continued in 2022 at an uncomfortable, alarming pace, exceeding central banks' targets in not only the US, but most of the largest global economies. Containing inflation is a priority, so continued monetary and fiscal tightening is most likely needed to tackle inflation and address debt susceptibilities. Although the recent CPI and PCE reports demonstrated a deceleration from projections, they are still increasing month over month, with core CPI at a lower rate this month, 0.3 versus 0.6 last month. However, they are still increasing. The core is key. Yes, we have persistent elevated inflation. Per Cleveland Fed forecasting, we are projected to be in 7s and 5% year over year, respectively, and monthly increasing by about 0.4 to 0.5%. That is very concerning. Of course, the upcoming CPI reports will provide us with the proper answers as to whether we receive a pause or cut. The data will speak for itself, so the next few reports are critical. Very important point. CPI is not inflation. It is an index used to measure inflation. Very important point. And the rate of change trend in the core is really the most important data point to look at. So that's what we always want to focus on, the rate of change in the trend of the core. We need to see a consistent pattern as well. And it is this consistent pattern over the course of months that Fed Chairman Powell, the Fed, looks at. Now, when you have 1 month of possible deceleration, which is the CPI core is up, it's still up 0.3 versus 0.6. So there you say, okay, we're up, but we're up by less. That's a deceleration. So we need to see that consistency over the next few months to even confirm there could be possibility that we are starting to decrease. So we need to see a pattern. So I'll repeat. Before we can conclude that we are making effective progress towards reducing inflation to more agreeable levels, we need to see a consistent pattern of at least a few months. Could this deceleration that we're witnessing lead to a deflationary economic condition? Anything's possible, so we remain open to that possibility. However, plenty of the other foregoing issues point otherwise. The Fed has work to do. In my opinion, the labor market holds the key. We have a tight labor market as demand for workers exceeds supply. Nominal wages have grown significantly. Wage inflation fuels nominal spending, which continues to drive nominal demand in a loop, which further facilitates entrenchment. That seems to be already occurring in wage and price settings affecting financial and household decisions. Therefore, increased tightness in labor markets is placing pressure on consumer prices. We need to reduce the nominal spending at the source. So I believe it is necessary to soften the labor market. Otherwise, they will keep chasing each other. However, the question is, how much softening is needed for stability? As we look deeper from our manufacturing business-to-business view, we see skill sets imbalances as a key driving factor. Expectations have changed significantly on both sides for the employer and the employee. Higher turnover and seeking expenses for businesses due to these mismatches, coupled with the time-sensitive sifting process from too many mismatches, with the qualified applicants getting lost in the mix. How much to soften? Let's look at the data. The unemployment rate is only one data point. So we have very low unemployment at 3.7% and non-farm payrolls at 263,000 new jobs. But are those numbers really reflective of what is going on? Back in August, I reported and I tweeted about the disparity between the household and establishment surveys. They utilize different methods in data collection, and being a skeptic, I looked deeper. There have been a rise in multiple job holders since early 2021. In the household survey, there is no duplication. But with the establishment survey, which is what is used to calculate the jobs count, employees working at greater than one job and appearing on more than one payroll are counted separately for each appearance. That's interesting. So are the jobs numbers as high as reported or much less? Is this noise? Or are these inconsistencies worth further study? Recent initial claims are at the lower end, plus there are data lags and delays for these claims. For softening, there should be a rise, and studies demonstrate for economic weakness, these should exceed about 400,000, about 420,000. Although the recent JOLTS number changed little, it is inarguably still high. Two rate of job openings ratios that are effective measures to examine the tightness of the labor market and can assist us in explaining price and wage pressures are Beveridge curve, the job openings to unemployment ratio, and fill rate, the job openings to hires ratio, both suggesting less softening may suffice, with fill rate suggesting the least. These patterns all imply that an elevated number of people taking jobs are not coming from the unemployed. As I said before, the number of multiple job holders have been increasing since early 2021. Both ratios were very high, with the fill rate less above its trend. A concern for the labor market is that between tightening liquidity and higher rates, as well as the other aforementioned employment data possible inconsistencies, unemployment can trickle upward at an increasing pace, and it may be very difficult to stop once it starts. Therefore, in my opinion, rate cuts are a remote possibility very late next year, possibly December, or early 2024 if the labor market weakens significantly, coupled with a moderate to severe recession. Nonetheless, we should continue to experience significant pressure on the labor market with declining negative productivity and low labor force growth, even with a 2.8 real growth. As of now, Fed terminal rate is in the fives mid next year, with Powell saying over 5 by September. As Bullard said, we should be about 5 to 7%. It is plausible. Studies demonstrate that rates should be higher than CPI by about 1.5% to 2% to break the back of inflation. Therefore, the Fed could raise rates more than currently expected and leave them there longer than one might expect. This is all dependent on the next few CPI prints, as we need to see a consistently declining pattern. So we are currently at 375 to 400 Fed terminal rate. The Fed funds rate, if we get 50 basis points in December, which seems very likely, I think Fed Watch Tools said about 75% today. That's in next week, I think, is the Fed meeting. I think it's December 14th. Then we go to 425 to 450. And then we get another 25. That's what the Fed Watch is saying is the highest probability. If we get 25 in February, we'll be at 450 to 500. I believe there's a meeting in March or April, no, May. After that, we have 50 basis points that we need so to get to 500. So if we do 25, then we'll be about there by June, by the summer. Do we know if that will suffice to get the job done? No. I always keep an open mind as things can and will change. Per Powell at last Fed meeting, he said, "It's too premature to speak of a pause. We are at a low end and have ways to go." His sole focus is to bring down inflation, and it is warranted. Per Powell, 3 lessons we learned from the 70s and 80s. It is a central bank's responsibility to deliver low and stable inflation, achieve price stability. 2, we need to avoid entrenchment and the anchoring of high inflation, a real issue that we must avoid to prevent a prolonged effect. And 3, keep at it until it's done. He also discussed 3 goals, and we aren't there yet. 1, below trend growth. 2, softening of the labor market, supply and demand imbalances. There are also many skill set mismatches. And 3, clear evidence of inflation headed to 2%. Well, in my opinion, does not seem likely with the current prints and projections. Their tool is to raise the Fed funds rate through tightening monetary policy. And that is what they have available to them. Or we can have taxation through fiscal policy, but no one wants that. So it seems that Fed fund rate is the way to go. That's what the Fed will be doing. Could inflation possibly remain greater than 2% and in the range of 3 to 4%? Could we be at a new level? Absolutely. Only time will tell us that answer. It is plausible. We're open to anything. Anything is possible at this point. Pain now to prevent worse pain later on, as Powell has said. The Fed has work to do. We should remain aware that persistent elevated inflation could require rate hikes greater than currently anticipated, further tightening of global financial conditions, and increasing risks of a sovereign debt crisis for susceptible economies. Bringing down inflation is a key policy priority. The ultimate goal and priority in most economies, including U.S., is to ensure price stability while bringing down debt levels and protecting those most vulnerable without breaking anything, such as the labor market or the housing market. Therefore, with all the foregoing, I maintain that rate hikes should continue with a slowdown near term, and then most likely weaning off and then a pause. It takes time for these rates to work through the system. It is too premature, in my opinion, to discuss a pivot or a cut yet at this time. I prefer to plan for about 6 months or so. As of right now, I could anticipate a pause, possibly Q2, Q3 of 23. So let's just focus on that part first. However, this recent pattern of deceleration could materialize to deflationary economic conditions. In my opinion, I don't believe that we're going to go from a high inflation to a deflation. I don't think that's going to be the pattern in this situation. However, we remain open to possibilities. Or within 12 months, there could be potential employment challenges that could surface, which is a possibility with over-tightening, and then a surge in claims and unemployment accompanied with a moderate to severe recession. Then rate cuts are a possibility late next year in second half of 23, possibly December, maybe early 24. We shall see. We remain open to all possibilities during this time of uncertainty as new information becomes available. The only certainty is uncertainty. Of course, this can change quickly if the data changes, but so far it has not significantly enough. We will see with the next few CPIs. I always keep an open mind and remain flexible. We are data dependent, so as new data comes in, the moving parts keep moving and changing their synergetic outcomes. And once again, the only certainty is uncertainty. So let's take a look. We've gone through most of these points. Well, we have labor wage inflation. Now, most people think it just means you're paying employees more. And it's not just that. As I said before, there's sifting expenses. There's going through all these applications, the time it takes to find the right application, the right worker, because there's a skill set mismatch. There's different expectations on both sides. And we're getting a lot of turnover expenses, and that's very costly for the business. It's very time sensitive and labor intensive. So those are a lot of expenses that many may not calculate when taking into account this wage inflation. And also there are a lot of surcharges, new fees in this post-COVID time period. And it's the IAS, the interest assessment surcharge. And that has to do with New York State. It's a New York State fee for employers that I believe they ran out of money for enhanced benefits for employees. And they had to borrow it from the federal government. So this is a fee that you're paying for that. I'm not exactly 100% on that. That's not my area of focus, but I believe it had something to do with that. So there were a lot of new fees, and that's the point. Wage inflation includes a lot of other factors. So that's when you say, is inflation embedded? And it seems to be at all levels. There's so many new factors that we need to take account of. And with the rising rates, there's also a recalibration of risk and how much risk you're willing to take on. So investments are viewed differently in a quantitative tightening world that we're in now compared to quantitative easing that we've had for such a long time. So we need to factor that into our investment strategies. So let's go right into the next question, which is, what are the best sectors to keep an eye on during and after a recession, and why? Well, we've got to first look at the risk-adjusted returns. And risk-adjusted returns take into account risk compared to the risk-free treasuries. So as interest rates go up, then we know that we have to get more of a return to take on risk. So it just makes sense. And then also you can refer to the equity risk premium, which is the difference between the 10-year yield and SPX. So like the yield on both, there's a premium, there's a spread between the two. So we need to receive higher yields, earnings yields from SPX to compensate for the higher 10-year yields. So we need to be paying lower prices and valuations need to come down. So you see how it works. So as these rates go up, it affects the market in that way. Now we know that the yield curves are inverted, the 10-year, 2-year, and the 10-year, 3-month, the global yield curve is inverted. These are all signals for a recession, and they've been going on for a while. Doesn't mean an immediate recession. So we have a 10-year yield against the Fed funds rate is inverted as well. So there are a lot of issues going on, but to me, the labor market is key when looking at how to help break the back of inflation. Because wage inflation, as discussed earlier, causes the nominal spending and so forth. It's like a wage price spiral. So there are a lot of issues with that as well. So let's begin with where we are now. Earnings are under pressure. As rates rise, we experience not only rises in costs of debt and capital for businesses, but future valuations are also diminished and growth is further slowed, adding to compressed margins. Margins are compressed with rises in the cost of capital, debt, production, labor. And as a result, cost of goods sold and operating expenses are much higher. Seemingly, revenues are being held up more so by inflation and increased prices than higher output or volume. As you can see, inflation works both ways. Productivity is down. There's less output per dollar. Marginal costs have increased significantly. There is a dilution of value. We are getting less output for each input. Inflation appears to be embedded at all levels. Deterioration of profitability is the next challenge, in my opinion. I repeat, corporate earnings are already under pressure due to compressed margins and slower growth, and I believe should continue and most likely worsen into next year with continued slowed global growth and rising rates and upcoming employment issues as well. Therefore, I would exercise caution with the 60-40 positioning, as equities could experience further downward risks, especially with stagflation potential. It hasn't been working for most of this year except for select stocks, fundamentally sound and value focused. The bond bear market this year may have some temporary relief. However, sustained upside is uncertain. Regardless, we always remain flexible and change our minds and positions accordingly and quickly as we receive new information. Both capital losses and weaker corporate balance sheets are likely to be increasing and thus contributing to further lowered productivity and capital stock. With such a tight, strong labor market, it is difficult to classify that we are in a recession. But I believe we are most likely headed into one, and potentially a stagflationary one. If we ask the American people if they felt we are in a recession, they may acquiesce. From a manufacturing business perspective, where contraction is commonplace, yes. Maybe an atypical recession? Nevertheless, I believe inflation may persist and maintain elevated levels for some time, possibly mid next year. Let's look towards manufacturing for some more ideas here. Manufacturing data tends to be a forward indicator for earnings as well as trends. Per recent data, in addition to my perspective from the manufacturing forefront, we began experiencing the slowdown late 2021, early quarter one 2022. Productivity has been declining as there is less output per dollar, as more capital is required to produce each output. There has been a change in the worker as well. Bottom line, when companies reinvest their profits, the real output produced for every nominal dollar invested keeps decreasing. We have also noticed that there is a rotation of sectors and industries, as well as businesses making their CapEx purchases, which is closely in line with PMI, ISM, and manufacturing indexes. Although our business data is only a sample, it is very reflective of the prevailing data. Less startups, which have waned significantly lately as there are more sensitive to rising costs for expansion and maintaining cash flow, while margins are compressed. There's also more larger established companies making their purchases, as well as mid to large cap publicly traded companies, which have comprised the larger portion of our sales lately, depending on industries, which I will highlight. Rotation is also more into inelastic industries, including industrials, industrial production, aerospace, machinery, transportation equipment, more consumer staples, chemicals, also an increase in medical businesses, prosthetics and orthotics, industrial production, turbine engines, metal molding and casting. Overall, less consumer discretionary businesses are making CapEx purchases. Spending patterns have changed, and as businesses and consumers get squeezed, these trends should continue. Debt is rising, savings are decreasing. Of course, everything is subject to change upon many factors. We can only speak with certainty about what has and is occurring, but hypothesize on the future based on this current data against historical patterns. But no one knows the future. These are challenging times nonetheless. However, challenges bring new opportunities. Therefore, in my opinion, these are opportunistic times for businesses and investors. This is when businesses grow and seize opportunities, adapting and innovating by streamlining their business processes to gain market share through organic growth and vertically and horizontally integrate through inorganic growth. Remaining liquid to seize opportunities is key, as there will be many. We have seen this historically during and after economic crises. Into next year, commodities and inelastic industries are some areas I am looking at, as well as holding cash. Metals and sugar, gold, silver, other metals, lithium, fertilizers, agricultures, and more. The defensive, more inelastic industries, which are necessities such as utilities, healthcare, medical equipment, biotech, consumer staples, and select tech such as cybersecurity, which may also be a necessity, and or renewables, which could be a replacement for the regular energy sources such as oil. We're always hoping to be able to implement some renewable sources such as wind, solar, biofuels. As long as they have solid fundamentals, which is my focus as a fundamentally based investor, these could fare better. Fundamentals matter, especially with rises in costs of debt and capital. Therefore, I look closely at cash, free cash flow yields, free cash flow margins, rising earnings, future guidance raises, etc. However, I remain that I am cautious with equities in the 60-40 portfolio, and I'm looking more towards commodities and remaining liquid with cash. Most real assets have negative expected returns in this current environment, and then add inflation on top of that. Having cash at least only has the inflation factor. Cash is king. Therefore, a larger cash position to remain liquid to seize opportunities seems prudent. In conclusion, we can see that all four discussions are interrelated and part of the moving parts. China weak growth momentum affects the global economic slowdown, and their economic restriction causes further challenges. Russia's invasion of Ukraine with related sanctions has contributed to continued supply disruptions, rising food scarcities, and energy concerns. Nevertheless, persistently high and broad-based inflation is necessitating a tightening of monetary policies across the world among the major economies. There is a lot of uncertainty and things can change rather quickly. Many of the gains from decades of globalization are being challenged and unfortunately are likely to be destroyed due to the growing global fragmentation. Many downside risks exist, include a worsening energy crisis in Europe, to further negatively impact growth and inflation. We have also been experiencing increasingly severe weather events that may continue to harm growth across the world. Nonetheless, I will conclude on a positive note, as there are always opportunities that emerge from crisis. During contractions and challenges, we are placed on our heels. We are forced to be our best to survive. With the right mindset, we can remain flexible, adaptable, and innovative. This is how new industries, sectors, and leaders emerge. New ideas and better methods to overcome obstacles. Remaining liquid amidst tightening liquidity in order to seize these opportunities is key. It is about our perspective. We will survive and thrive, as challenges always breed new opportunities with the right mindset. Let us seize these incoming opportunities, as these are opportunistic times. So that wraps up that recap on the discussion today about macroeconomics and the outlook for next year. We also touched upon a little bit of Bitcoin. Now, Bitcoin is decentralized and allows everyone to be their own sovereign unit. And you could look at Bitcoin as not just an investment, but as a monetary unit, as currency. And when you start looking at it in that regard, I think it is the future, and it's going to be the way goods and services are transacted. And, the metaverse is coming, Web3 is coming. There's a lot of things going on. It may be some ways off in time, maybe like 5 to 10 years. But, these are all things we should research, we should read about. And I do have on my website articles regarding crypto, and that is a part of my wealth building website and investments in business. We talk about crypto because I think it's a very important part of diversification, and it's something to be aware of and to understand the underlying mechanics of cryptocurrencies and not just what the media and the headlines say about crypto. We should try to understand the meaning of it. And there's a big philosophy behind it, and it does make a lot of sense. So I urge you to come to my website and you can read about crypto. And we are just, we're working on building that part of the site. Now, NFTs are an interesting entity. they deliver ownership in a very revolutionary way. And it has a lot to do with scarcity and supply and demand. So in some ways you could view it as very inelastic. There's only one person who holds it. And if others want it, well, there you go. The demand is high, and there's someone, there's a need for that. Now, if there's no demand, then right there you have prices will probably go down. So it's a very interesting phenomenon with supply and demand and scarcity with the NFTs, but they're very revolutionary in the way they deliver ownership. So Bitcoin, crypto, NFTs, interesting topic all in themselves. So thank you so much for listening. I think I've touched upon quite a bit. I hope I didn't put you to sleep. Some of these topics can get a little dry at times, and I hope to keep it lively and entertaining for all. These are great things to learn, and I try to keep a very opportunistic view. I tend to be positive. It's about mindset and perspective. There's no black and white in the world. Everything's gray. So it's how you choose to view things, and you can look at challenges as opportunities, because through challenges we emerge stronger and better, and we find new ways. If you look at historically in society, in the world, that is what occurs. You just have to try to see through the challenges, and I know it's difficult, but there are brighter days ahead. So thank you so much for listening, and until next time, have a nice day. Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon.